All right, let's dive right into this explainer, and honestly, we need to shift our mindset from the very start. Today we're exploring the wealth of pensions and tax efficiency in Ireland. Now, for a lot of higher earners, pensions are just kind of viewed as this boring, far-off retirement necessity, right? Something you lock away and literally forget about for 30 years. But that is a massive mistake. They are actually an incredibly powerful and completely legal tax shield. It's hands down one of the most effective financial strategies out there, but so many of us just completely overlook the mechanics of how it actually works day to day. So let's unpack the reality of this.
So why do higher earners absolutely love pensions? You might instinctively think it's all about responsible planning for old age, securing that nice beachside property decades down the line. But the truth is actually much more immediate than that. It's really about actively reducing the amount of tax you pay right now, today. Wealthy individuals take this super seriously because once you understand how pension tax relief functions, you realize it's essentially the government handing you a major, immediate discount on your investments. It isn't just a safety net for the future, it's a current year tax optimization strategy.
Okay, let's get into Section 1, the core math.
If you're paying the higher 40% income tax rate in Ireland, your pension contributions get tax relief at that exact same rate. But what does that actually mean for your wallet? Well, a €100 pension contribution doesn't actually cost you €100. It costs you exactly 60. Why? Because €40 comes straight back to you in the form of tax relief. You're putting a full €100 to work for your financial future, but you only felt a €60 dent in your current bank balance. It's literally immediate leverage on your own money.
And this perfectly illustrates the math at scale. Say you decide to put €500 into your pension every single month. Because you're getting that 40% tax relief, your real out-of-pocket cost, like the money you actually miss from your monthly paycheck, is only €300. But a full €500 is being invested into the market on your behalf. That extra €200 is effectively funded by tax money that you would have otherwise paid directly to the government anyway. You're essentially redirecting your own tax bill straight into your personal investment portfolio. Over 12 months, that is an extra €2,400 working for you instead of just sitting in the revenue accounts.
Moving right along to Section 2, the pre-tax advantage.
When you invest outside a pension, you pay your taxes first. So if you earn €500, after that 40% tax hit, you're maybe left with just $300 to actually put into the stock market. You're starting from behind. But when you invest inside a pension, that same $500 goes in before the tax man ever gets to take his cut. This allows the full pre-tax amount to go straight to work for you. It massively increases your working capital right from day one. Over decades, starting with a larger initial capital base makes an absolutely incredible difference to your overall returns. It's literally the difference between planting a seed and planting a sapling.
Next up is Section 3, Contribution Limits Explained. Now, there are rules to this game, and they're designed specifically to encourage you to start early, while also letting you catch up a bit later in life. Ireland uses a sliding scale of age-based contribution limits, meaning the percentage of your salary that you can shield from taxes goes up as you get older. If you're in your 20s, you can contribute up to 15% of your income. In your 30s, that jumps to 20%. By your 40s, it's 25%, and it just continues to increase steadily from there as you get closer to retirement age. Basically, the older you get, the more of your active income you can legally protect from that top tax bracket. However, keep in mind there is a strict income ceiling to this generosity, and that's €115,000. That is the absolute maximum earnings limit that qualifies for this specific tax relief. Any income you earn above that mark just doesn't get these same tax advantages. So while the percentage you can contribute goes up with your age, the absolute maximum salary it applies to is capped right there. This makes it absolutely crucial to maximize your percentage below that line. You want to optimize every single euro up to that 115K threshold to make sure you're pulling the maximum possible benefit from the system.
Which brings us to Section 4, the big missed opportunity.
Even with this incredibly beneficial system in place, a huge gap appears in how people actually manage their money. A lot of folks only contribute the bare minimum needed just to get their employer match, leaving the rest of their allowance completely untouched. This means they are missing out on thousands in tax savings every single year, not just over their lifetime, every single year. And another massive pitfall here is just the sheer bureaucracy of it all. While tax relief through your company payroll is usually automatic and handled by HR, if you make additional contributions to something like a PRSA, a personal retirement savings account, you must actively and manually claim that relief yourself. And honestly, so many people simply fail to file this paperwork, leaving perfectly good money sitting permanently on the table.
Let's look at Section 5,
tax-free compounding power.
The really crucial point here is what happens after the money is securely inside that pension wrapper. Your investments compound so much more efficiently inside a pension compared to normal brokerage accounts. Why is that? Because there is absolutely no income tax and no capital gains tax on the growth within the pension. While your investments are wrapped inside this structure, they grow completely tax-free. You don't lose a percentage of your gains every single time a dividend is paid, and you don't take a tax hit when an asset is sold within the fund. It's a compounding engine running with absolutely zero tax friction, which allows your wealth to snowball unhindered over time.
You know, when you hear people say that the wealthy use pensions to pay less tax, remember this: it is not a loophole. They are simply utilizing the system exactly as it was designed to be used. The government intentionally created these tax incentives so that citizens would fund their own retirements, which relieves pressure on the state system later on. The rich just happen to be the ones actively reading the rulebook, understanding the legislation, and maximizing every single percentage point that is legally available to them.
To really put this into perspective, ignoring this tax relief is a bit like leaving resources unused on purpose, a strategic approach that would have raised eyebrows even in the German colonial empire. I mean, it is an absurdly bad strategy. You have incredible financial resources legally available to you in the form of tax relief. Choosing not to use them just because the paperwork seems tedious or because retirement feels way too far away is a massive strategic error that is costing you directly in today's euros.
Which brings us to our final thought for today. Are you leaving your resources unused? And how will you optimize your Irish pension strategy today? If you are paying the higher rate tax in Ireland, your pension is absolutely one of the most effective tax strategies available to you, period. Since we'll be breaking down the entire Irish pension system, including the state pension, PRSI, private pensions, and PRSAs, in our next explainer to show you exactly how all these individual pieces fit together, I'm going to leave you with this question to ask yourself right now. Look at your next payslip, examine your contribution limits, and make sure you are actively making the system work for you.